Hi, this is Juliet Orfiano. Welcome to my video. If this is your first time on my channel, please like, share, and subscribe so I can notify you if I have a new video. This is the continuation of part 12 about inventories. I discuss in part 12 about the inventory items that are ordinarily interchangeable, the weighted average method. Just click above or the link below this video to watch part 12. In this video, I am going to discuss the measurement of inventory. Measurement of inventories. Inventories or the statement of financial position should be measured at the lower of cost and net realizable value. Cost is determined by applying the specific cost formula used by the enterprise as discussed in the preceding section. Net realizable value is defined as the estimated selling price in the ordinary course of business less the estimated cost of completion and estimated cost necessary to make the sale. The cost of inventories may not be recoverable if those inventories are damaged, if they have become wholly or partially obsolete, or if their selling prices have declined. The cost of inventories may not also be recoverable if the estimated cost of completion or the estimated cost to be incurred to make the sale have increased. The practice of writing inventories down below cost to net realizable value is consistent with the view that assets should not be carried in excess of amounts expected to be realized from their sale or use. PAS or IAS number 2, Inventories, paragraph number 28. Inventories are usually written down to net realizable value item by item. In some circumstances, however, it may be appropriate to group similar or related items. This may be the case with items of inventory relating to the same product line that have similar purposes or end uses, are produced and marketed in the same geographical area. It can and cannot be practicably evaluated separately from other items in the product line. It is not appropriate to write inventories down on the basis of a classification of inventory. For example, finished goods or all the inventories in a particular industry or geographical segment. PAS or IAS number 2, Inventories, paragraph number 29. Estimates of net realizable value are based on the most reliable evidence at the time the estimates are made as to the amount the inventories are expected to realize. These estimates take into consideration fluctuations of price as well as the purpose for which the inventory is held. Estimates of net realizable value take into consideration the purpose for which the inventory is held. For example, the net realizable value of the quantity of inventory held to satisfy firm sales or service contracts is based on the contract price. If the sales contracts are for less than the inventory quantities held, the net realizable value of the excess is based on the general selling prices. PAS or IAS number 2, Inventories, paragraph number 31. Materials and other supplies held for use in the production of inventories are not written down below cost if the finished products in which they will be incorporated are expected to be sold at or above cost. However, when a decline in the price of materials indicates that the cost of the finished products exceeds net realizable value, the materials are written down to net realizable value. In such circumstances, the replacement cost of the materials may be the best available measure of their net realizable value. PAS or IAS number 2, Inventories, paragraph number 32. To illustrate the application of the lower of cost and net realizable value rule, assume the following information for different inventory items held by XYZ Company at December 31st, 2009. Item A, cost is 185 pesos, sales price 230 pesos, selling expense 35 pesos, units 5,000. Item B, cost 69 pesos, sales price 100 pesos, selling expense 30 pesos, units 20,000. Item C, 31 pesos, sales price 43 pesos, selling expense 15 pesos, units 15,000. Item D, cost 75 pesos, sales price 105 pesos, selling expense 37 pesos, units 18,000. The total cost of inventory is determined as follows. A, 5,000 times 185 pesos is 925,000 pesos. Letter B, 20,000 times 69 pesos is 1,380,000 pesos. Letter C, 15,000 times 31 pesos is 420,000 pesos. Letter D, 18,000 times 75 pesos is 1,350,000 pesos. The total is 4,120,000 pesos. The inventory value is determined as follows. Item A, cost 185 pesos, NRV SP selling expense 195 pesos. Lower of cost and NRV 185 pesos, units 5,000, total inventory value 925,000 pesos. Item B, cost 69 pesos, NRV SP selling expenses 70 pesos. Lower of cost and NRV 69 pesos, units 20,000. Total inventory value 1,380,000 pesos. Item C, 31 pesos, NRV SP selling expenses 28 pesos. Lower of cost and NRV 28 pesos, units 15,000. Total inventory value 420,000 pesos. Item D, cost 75 pesos, NRV SP selling expenses 68 pesos. Lower of cost and NRV 68 pesos, units 18,000. Total inventory value 1,224,000. The total value of inventory is 3,949,000. Thus, for total cost of 4,120,000 pesos to total value of inventory using lower of cost and net realizable value of 3,949,000 pesos, there is inventory write-down amounting to 171,000 pesos. Thank you for watching my video. I hope you learned something from this video. I did part 14 and continuation of this video wherein I discuss in part 14 about the write-down of inventory. Just click above and the link below this video to watch part 14. Don't forget to like, share, and subscribe on my channel so I can notify you if I have a new video. Once again, this is Juliet Orfiano. See you on my next video.